current volatility and fluctuation in global currencies have boosted the popularity of investing in the foreign exchange market. With me to speak about how best to navigate this industry is Ghassan Elias Kteily, AGM Chief Growth Officer for Royal Forex Trading. Well, Ghassan, the Forex market. Tell me about the opportunities and indeed the challenges it represents.
The abundance, if you like, or the approachability of the foreign exchange market makes it easy to trade. And a factor that really adds to that and enhances trading is the low margin. That's the leverage. The low margin, which is as low as 1% and sometimes 0.25% or 0.5%, enables you to trade like 200 times your money. It gives an opportunity to speculators to trade with very little money, big amounts of and volume of foreign exchange. However, it increases the risks and the rewards. So it is an opportunity and it's a challenge at the same time.
Well, Royal is a global financial trading brand and you offer your services through headquarters in both Beirut and Sydney. But when it comes to trading and data security, how do you deal with different jurisdictions?
We chose to be fully regulated in both jurisdictions, in Lebanon by the CMA, which is the Capital Markets Authority, and in Australia by ASIC, which is the Australian Securities and Investment Commission. So when we talk about data security, we're talking about protection against cyber attacks. Companies like Royal, through adhering to the requirements of the regulators, that is segregating the client's funds and putting in place proper risk management strategies, meeting with all the liquidity ratios, do guarantee that funds are secure and that the clients can worry about trading in the markets, not about their funds being secure or not with Royal and other companies.
And does trading in Middle Eastern markets differ from that of the West?
In the Middle East, investors are as sophisticated as they are in the rest of the world. However, 8 countries in the GCC and in the Middle East have their currencies pegged to the dollar. So for him, currencies are pegged and there isn't much uncertainty over there. People are tended to trade commodities, if you like, oil, gold, silver, and so on and so forth. Trading commodities is more risky than trading currencies. A Middle Eastern investor working on tactical, not strategic basis. And that's what makes his trading more short-term and abrupt. So quick trade and come out. While with the European investor, you'd find that he will take a strategic position like he does with equities and leave it for a longer term.
And when it comes to regulation, how stringent is your industry?
Very stringent. Regulators have opted for stipulating and dictating more rigid parameters and benchmarks that will regulate the industry. And accordingly, they have imposed, if you like, higher margins and more capital requirements and more ratio requirements, higher ratio requirements to ensure that companies stay on the safe side. Consequently, the investors and the clients and their monies are safer.
Transparency is, of course, a huge issue. How do you approach this?
Transparency relates to many aspects. There is the trading transparency. That is what you demonstrate on your website. You have to advertise and to promote what you really do offer. You have to be totally transparent with clients regarding spreads, fees, commissions, the depth of the liquidity you have. In volatile markets, clients would be concerned very much about having their orders executed, and this is what you should be transparent about. Basically advertising honestly and transparently how much you can help the client transact his transaction and his business through you as a company.
Now, finally, we have seen the Chinese stock markets having quite an impact on markets worldwide. So what other trends do you foresee impacting your industry over the coming months?
What I foresee is that moving forward for the next 18, 24 months, emerging markets and developing countries that are the major partners to China, take Brazil and other Latin American countries and some East European countries, which basically export steel and copper and wood to China. As the Chinese economy slows down, they are bound to be affected. Their currencies are going to be affected because if you export less to the second largest economy in the world, that means you are earning less foreign currency. Likewise, it will affect their capital markets because their borrowing powers will be less. You will have to borrow at a higher rate, and that means spending more, and that means your capital markets locally will be affected adversely as well.